It's hard to know how future markets and individual assets will fare. When it comes to investing though, a little knowledge goes a long way. With that said, in this video we'll be talking about top 10 things you probably wish you knew before investing. Let's get started. Starting off with number 10, make a financial plan for yourself. This is like stating the obvious, but we know it's the first step before investing. Having a plan is one of the most important things to consider before investing. This helps you put your investment goals in context, as well as how you want to attain them. It can also assist you avoid being swayed by your emotions and making investment decisions. There's no doubt that investing is a very emotional process. You may be tempted to change your investment plan if a portion of your portfolio is underperforming, or you recently heard news that the market is about to crash. While these occurrences may prompt you to respond fast, such as selling your asset, it's critical to think about your investing strategy. Making judgments based on short-term market swings may have a significant impact on what you set out to achieve if your method is intended to be a long-term strategy. Sit down and take an honest look at your complete financial condition before making any investment decisions, especially if you've never established a financial plan before. Identify your goals and risk tolerance, either on your own or with the assistance of a financial advisor. Is the first step to effective investment. There is no guarantee that your investment will provide a profit. However, if you learn the facts about saving and investing and stick to smart strategy, you should be able to build financial security and reap the rewards of money management over time. Number 9, examine your comfort level when it comes to taking risk. Every investment entails some level of risk. If you want to invest in securities such as stocks, bonds, or mutual funds, you should be aware you could lose part or all of your money. Unlike deposits of FDIC covered banks and NCUA insured credit unions, money invested in securities is rarely protected by the federal government. It's possible that you'll lose your principal or the money you've put in, even if your investment's through a bank. This is true. The potential of higher investment return is the reward for taking on risk. If you have a long-term financial objective, you are more likely to make money by carefully investing in asset categories with higher risk, such as cash equivalents. For short-term financial goals, however, investing primarily in cash assets may be beneficial. Individuals investing in cash equivalents should be concerned about inflation risk, which is the danger that the inflation will outstrip any road earnings over time. Moving on to number 8, consider a well-balanced investing portfolio. An investor can assist protect against severe losses by including asset categories with instrument returns and fluctuated with market circumstances in their portfolio. The 3 primary asset categories, stock, bonds, and cash, have never moved up and down at the same time in the past. Market dynamics that cause one asset category to perform will often result in ordinary or bad returns in another asset category. An investor can assess protect against severe losses by including asset categories with investment returns that fluctuate with market circumstances in their portfolio. The 3 primary asset categories, stocks, bonds, and cash, have never moved up and down at the same time in the past. Market dynamics that cause one asset category to perform well will often result in ordinary or bad returns in another asset category. Furthermore, asset allocation is critical since it has a significant impact on whether or not you will achieve your financial objectives. Your investments may not produce a significant enough return to fulfill your goal if you don't include risk in your portfolio. For example, most financial experts believe that if you're saving for a long-term goal, like retirement or college, you'll need to incorporate at least some stock or stock mutual funds in your portfolio. If you plan to invest extensively in shares of your employer stock or any other particular stock, exercise caution. That's on number 7. Diversifying your investments is one of the most essential techniques to reduce the risk of investing. As the saying goes, don't put all your eggs in one basket. You may be able to limit your losses and lessen investment return variations by selecting the correct group of assets within an asset category without losing too much potential gain. If you invest extensively in shares of your employer's stock or any other particular stock, you'll be exposed to severe investment risk. You'll almost certainly lose a lot of money if the stock performs poorly or if the company goes bankrupt, and perhaps your job. Number 6, make emergency funds and keep it up to date. Most savvy investors set aside enough money in a savings account to cover an unexpected event, such as being laid off. Some people put up to 6 months' worth of income in savings to ensure it will always be available for them when they need it. 5th, pay off credit card debt with high interest rate. There is no investing strategy that pays off as well as, or with less risk, than paying off all of your high interest debt. If you owe money on high interest credit cards, the best thing you can do is pay off the sum as soon as possible, regardless of the market conditions. Fourth, take a look at the dollar cost averaging. By following a consistent pattern of adding fresh money into your investment over a lengthy period of time, you may protect yourself against the risk of investing all your money at the wrong time using the investment approach known as dollar cost averaging. You will buy more of the investment when the price is low and less of an investment when its price is high. If you make regular investments with the same amount of money each time, individuals who make a lump sum contribution to your IRA towards the end of the calendar year or early in April may wish to consider dollar cost averaging as an investment strategy, especially in a turbulent market. Third, take advantage of your employer's free money. You might not know about this, but many employers may match a portion or all of your contributions to a retirement plan. You are wasting free money if your retirement savings, if your workplace offers a retirement plan, and you do not contribute enough to receive the full match. Maintain your cash flow. A workplace plan is in most situations the most effective way to save for retirement. Before taking a loan from your retirement account, thoroughly consider your options using a 401k. Debit card, in particular, should only be done as a last option. Borrowing the money today will lower the amount of money you have available to save over time, and ultimately, what you have when you retire. It may also be subject to federal income tax and penalties if you do not repay the loan. Secondly, consider rebalancing your portfolio on a regular basis. Rebalancing is the process of returning your portfolio to its original asset allocation balance. Rebalancing your portfolio ensures one or the more asset categories are not overemphasized, and it returns your portfolio to a reasonable level of risk. Your portfolio can be rebalanced based on the calendar of your investments. Investors should rebalance their portfolios on a regular basis, such as 6 or 12 months, according to several financial gurus. The advantage of this strategy is it uses a calendar to notify you when it's time to rebalance. Other advice rebalancing only when an asset class relative weight grows or lowers by more than a particular percent that you determine ahead of time. The benefit of this approach is that your investments will alert you when it's time to rebalance. Rebalancing in either instance works best when done on somewhat occasional basis. Here's a little tip with this rule. Maintain your strategy purchase at a low price and sell at a high price. It may be difficult to shift money away from a performing asset category in favor of a struggling asset category, but it can be a prudent move. Rebalancing forces you to purchase cheap and sell high by reducing the number of current winners and increasing the number of current losers. Lastly, avoid situations that could lead to fraud. Scammers read the headlines as well. They frequently exploit a widely recognized news story to entice potential investors and make their opportunity appear more real. Before you invest, the SEC suggests you ask questions and verify the answers with an independent source. Before investing, always take your time and consult with reliable friends and family members. Now that you know the 3 basic rules before investing, you think you're ready now to invest? Let us know by leaving a comment down below. That's all for now. Thanks for watching. See you in the next video.